Paul, great having you. I wonder how you're looking at the chessboard. It's continuously moving, right? And it's switching fairly quickly. How are you looking at it? And how should one look at markets given the kind of moves that are happening?
Yeah, you raised a very good point. There was a lot of news over the weekend, geopolitical, particularly with the war between the U.S. and Iran. And then you hit the nail on the head, the FOMC. What do they do about rates? The Fed funds futures contracts here in the U.S. are telling us that they will do nothing, though inflation is bringing a lot of pressure to raise rates, but just a politically probably impossible thing to do. And then, of course, I'm primarily a tech analyst, and we're all looking for 4 of the Mag 7 and other critical companies in the U.S., technology and otherwise, all reporting their earnings and giving guidance for the next quarter all this week. So it'll be very busy.
Paul, hi. Sajid here. So do you expect the tech stocks to be the focus this week, even as we expect maybe a tweak in language from the Fed side, but rates held stable at this point?
Yeah, I think that, again, the Fed funds futures are telling us that the rates are going to be stable. I don't think Kevin Warsh has any political capital to go against the president and raise rates, almost regardless of what the inflation is telling us to do. But yes, a lot of companies are reporting this week, but they will be dominated by 4 of the Mag 7. And we all are watching to see what these companies say about their capital expenditures for AI chips and equipment, not just for 2026, but also for 2027. And so far, we've only heard from Google, that was last week, and then we have 4 of the other giants talking about their capital expenditures this week.
The other thing, Paul, is how is it that you sense global flows are going to move? And do you sense something that's already played out in bits and starts, money ease off from markets like Korea and Taiwan? Or do you think that concentration will still continue?
I think the concentration will continue. I watch all of the markets. I think that the U.S. market is particularly fragile, and there might be better opportunities abroad. Actually, I believe that strongly, because what's happened in the United States is our market is always driven by technology. The S&P 500, our bellwether index, about 40% exposure to tech. And at least the last couple of years, the tech sector has been driven by AI capital expenditures. We don't really have any AI revenues yet. We're still building. So one of the things that we saw last week is when Google did very well with their cloud business. It was up 82% year to year in revenues. I was expecting only up 60%. And they increased their CapEx budget to $205 billion for this year and said they're going to spend even more in 27. But a year or two ago, that would be welcomed with a big jump in the stock price, yet the stock went in the other direction. So now when companies are reporting that they're going to spend more and more and more on AI, that used to be welcomed by the market, that was a good thing. Now it seems to be a bad thing. So that worries me because AI controls tech and tech controls the US market.
Paul, just quickly diverting, how should one distribute between asset classes? How is risk reward looking? Equities versus debt versus, say, precious metals, gold and the like, given the current macros and the uncertainty?
Yeah, I would continue to have a probably overweight position in commodities because I continue to be worried chiefly about inflation in the States. We now have yields on not just treasuries, but on corporates that are high enough that they're starting to get attractive, and they'll probably take some market share away from equities. And as I said before, maybe equity should move to an underweight position relative to bonds because of these worries that we're spending too much stuff on money on AI gear and we won't get an ROI on that, and that could be really bad for US equities. So unfortunately, we've had a melt up in these AI stocks over the last couple of years. If there's any signs that the AI spending boom starts to crack, that'll be really bad for US equities. So maybe it's time to allocate away a bit from US equities into foreign equities, and then in the United States, more commodity exposure, more fixed income exposure.
Paul, how would, if at all you have a view, how would India stack up there?
I think India is very attractive. And particularly as we continue to ramp AI, not just in the United States, but abroad, I see a lot of opportunities in the Indian market. I continue to love some of the other Asian markets. I've always been a big fan. Probably the most important company in the entire world in the tech sector is Taiwan Semiconductor. And so, yes, we'll watch it all. It also looks like there is going to be a very hot Chinese memory equity offering. Looks like it's already out. And that should be a real blessing for that market, because it looks like that is going to open up 4 to 5-fold from its IPO price.
Interesting. Paul, great to chat with you today. Thank you so much for your time.